Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options.
Now, of course, the further apart our strike prices, you take, for example, Apple, we collect a premium at, say, $200. I'll just throw the example out. And then the next premium and then the strike price that we have from a call option perspective to protect that is going to be up at maybe 205 or 210. So the idea is that the wider the strike intervals, the more risk we're actually exposing ourselves to. So moving forward here, and you guys are getting a little further ahead here. We're gonna look exactly at what we consider when establishing our support and resistance levels, and the question is, how far back do we look? Well, because we're looking at creating these strategies on a short-term basis, we're going to go back and we're going to look within the last few months and really just try to establish some important levels that we feel are going to be well respected with respect to the particular security. Now, just to kind of finish up with the construction of this strategy, what happens once we purchase that call option above the sold strike price is that the cost of that call option is subtracted from the credit received. What happens again is if the pair value stays the same or drops, we keep the credit. The options expire worthless. We don't have to do anything to offset the position, and we can move forward and look at look into another set of opportunities for the following month. What I want to take a look at here is the YUK. Now, this reflects the U.S. dollar versus the Japanese yen, and as we can see here, just based on a simple quick look at the chart, we can see that there's been a respected level within this 94 to 95, what we like to call focal zones. And so the idea is that we've seen the pair value move up towards that level. In fact, if I could expand this out, you'll see that it's been tested on several other occasions. I just didn't have enough room on my charts. But the idea is that this level right in here has become a very well-respected resistance level. So if we're looking to identify a particular strike price that where there is a higher probability of it expiring, we would look to sell an option contract, a call option contract that is essentially above this particular level. So the idea is that we would look at something in the realm of the 94, 95 to take advantage of, and our outlook would really effectively be that we do not believe that the YUK is going to be trading above this within a specific time frame. We may see the YUK come up and test that, but we feel that there is strong resistance here, so that at the very least it will this particular pair value will move higher, move towards it, but then ultimately look at rejecting off of that before it actually trades beyond it. Okay? Now, the one thing that I just want to reinforce here, and my point quite well observed here with this one trading day last Thursday, is that if you're somebody that sold a naked put up here at 94, recognize that ultimately within the day we saw a 5-point, greater than almost a 6-point drop from the point at which the market opened, and ultimately the low that it hit that day. If you're somebody that's trading options naked, understand that every dollar that this goes against you, you have an obligation to your broker. And your broker is going to be looking at this particular move and saying, look, if you don't have the money in your account, we got to liquidate you, which means you're taking a loss at any one of these levels here. Doesn't matter that the market completely snapped back as the YUK did and moved back up to these particular levels here. The fact is, creating a naked position, again, I'm not suggesting that it's not a viable strategy, because it's something that we implement ourselves under different circumstances, but you have to understand that in the event that we have this kind of move in the market, being naked means that you have an obligation, and your broker's going to make sure that you have the capital in your account to cover that obligation, or else they're going to liquidate you. Now, question from TJ: with a spread, do we ever have to be worried about assignment, or does the option you buy cover you, and the most you can lose is the spread minus the credit? The nice thing about these FX options is that we don't have to, there's nothing to be assigned here. In other words, your profit and loss on these particular FX options is simply based on, if you're selling them, simply based on the credit that you've received, or your loss, the difference between the strike you sold and the strike that you bought to protect. But there's no, because there's no underlying security, these are cash settled. So you have to just, again, understand that on expiration, number one, because they're European exercise, the idea of an early assignment is not going to take place. The settlement of these options will not take place until noon on the expiration Friday. So settlement is based on the noon rates of these particular pairs on that on expiration Friday. So ultimately, you're either going to have the equivalent of the credit finalized in your account, which you get the credit right away, obviously, but those options are going to expire, or you're going to ultimately assume the full loss, or a percentage of that loss in cash. You're not going to have to deliver any of the underlying anything of the underlying security. So this is why I think that this particular market, these ISEFX options, for somebody that's a little maybe unsure of the mechanics. Now, let me reinforce that you should always be well aware of the mechanics of how any particular security trades. But people that are, just as this question was posed here with respect to assignment, it's all cash settled. So you don't have to worry that you're going to receive so many shares of something, or you're going to have to deliver so many shares. It's going to be the cash equivalent that is settled out of your account. Now, with the question is, with regular American style options, that's true. Absolutely. When you're looking at an American style option, that means that at any point in time, somebody, if there is a financial benefit to themselves, can exercise their rights, and you will have to deliver the underlying security, but at the particular price, or you'll have to buy the underlying security at the particular strike price. The great thing about these ISEFX options, they're European style, so you don't have to worry about that. They're all cash settled European style, so you don't, although you need to be managing your position throughout the life cycle of the trade, understand that on expiration, they're cash settled. Nobody can come to you partway through unless you're naked and your broker says you don't have enough capital to cover. But nobody's going to come to you partway through and say, all right, it's time for you to fulfill your obligations. Okay, so definitely something to consider. Now, the idea here, again, TJ's got a question, and maybe what we'll do is I'll just answer this and then we'll move forward, just because we're getting on with the time. But the question from TJ is, are you covered by the option you purchased? Well, absolutely. I'm going to build this strategy out for you in a second here, because first of all, what we're trying to do is, what option contracts do we want to sell here? Now, I've used just a very simple outlook here, just by identifying visually a resistance level. The other way that we can do it is we can use Fibonacci. Now, we've done a great many number of tutorials and webinars with the ISE on utilizing Fibonacci retracement levels. So I'm not going to get into it too much right now, but the idea is that we're simply looking at a measured retracement of a particular move, and you can see here as well that Fibonacci 61.8% retracement is identifying a key resistance level within that 93-94 zone.
Thank you for participating in this week's session. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts.